Welcome back to the Chart Ledger Deep Dive.
Great to be here.
Today, we're taking a deep plunge into Intel's recent Q2 2025 earnings report. I mean, a foundational giant in chips, right?
Absolutely. INTC.
You sent us a fantastic stack of sources, financials, analyst notes, tech news, the works. And our mission, as always, is to cut through all that noise.
Yep, get to the core of it.
You want to give you the most important nuggets, make sense of INTC, the good, the bad, and, well, yeah, even the ugly.
It's a complex picture right now.
Definitely. We'll keep it concise, clear, simple, so anyone can grasp the key takeaways.
Yeah.
Okay, let's unpack this huge turnaround story. So let's dive right into the good. Because look, despite a really tough market out there, Intel actually managed, well, they managed a couple of bright spots.
They did.
First off, that revenue beat. Pulled in $12.86 billion, which was a bit above the $11.9 billion estimate. Now, okay, a beat's a beat, but for Intel right now, what does this actually tell us?
Well, that's a great question because, any beat is welcome news, but the real insight here is where that slight growth is coming from.
Right.
Their data center and AI division, for instance, showed a 4% increase. Now, what's fascinating is that this suggests their big strategic shift towards these higher growth areas, especially AI, might actually be starting to gain some traction.
Okay, so early signs making.
Early signs, yeah. It hints at some resilience, maybe a rebalancing away from, older declining stuff. And for a company Intel's size trying this kind of massive transformation, that's vital.
That makes total sense.
Yeah.
So growth in key spots, but they're also getting really serious about the bottom line, aren't they?
Oh, absolutely.
Our sources highlight some pretty massive cost cutting. We're talking, what, 24,000 employees? That's like 15% of their staff.
It's huge.
And scrapping projects, Germany, Poland, Costa Rica. Plus, they lowered targets for OPEX to $17 billion and CAPEX down to $18 billion for 2025.
Yeah.
That really sounds like a company tightening its belt, doesn't it?
It absolutely does. And look, this kind of fixed cost discipline is just crucial right now. Think of it like trying to turn that supertanker, like you said, in really choppy waters.
Yeah.
You got to shed weight, get rid of inefficient systems. It signals they're serious about efficiency, about profitability over just, scale everywhere.
And they're doing this while still hitting roadmap goals.
That's the other key piece. Their roadmap milestones, like Panther Lake processors and, critically, the 18A node wafers, they're still apparently on track for 2025.
18A, that's the really advanced manufacturing process, right?
Exactly. It's about how small and powerful the chips can be. Staying on schedule with that cutting-edge tech is something analysts are watching like hawks. It sort of validates parts of their turnaround efforts, suggesting they're focusing resources, not just cutting.
Okay, so definitely some glimmers of progress. Revenue beat, strategic growth showing signs, serious cost discipline. But here's where it gets really interesting. Intel also faced some pretty significant headwinds in Q2.
Significant is right.
The big one, the most glaring bad news. 6 straight quarterly losses. That's a tough streak.
Yeah.
A Q2 net loss of $2.9 billion.
Yeah.
Now, you see two figures here. A GAAP loss of 67 cents per share, non-GAAP loss of $10. Can you quickly unpack that difference for our listener? Why does it matter?
Sure. It's key for earnings reports. GAAP, that's generally accepted accounting principles, is the strict standard. Includes everything, even those big one-time charges like restructuring costs Intel had.
The full pictures.
The full unvarnished picture, yeah. Non-GAAP, on the other hand, often pulls out those unusual one-off items. The idea is to give, arguably, a clearer view of the ongoing operational business.
But either way.
Either way, yeah, the losses continue.
Right.
Especially that GAAP number, it really underscores the depth of their financial challenges, the painful side of this transformation.
And it's not just the bottom line loss. Margins, which are so vital for profitability, they're under immense pressure too, aren't they?
Oh, absolutely. Gross margin, the profit, after just the cost of making the chips. It shrank significantly, dropped from about 38.7% last year to frankly, concerning 29.7%.
Right.
And operating margin, even deeper in the red, at negative 24.7%. That points to pretty fundamental profitability issues. It's not just about selling more, it's about selling profitably. And right now, that's a struggle.
And then there's the big elephant in the room, the Foundry business.
Ah, yes, the Foundry.
Intel's massive bet on making chips for other companies like TSMC does. Their cutting-edge 14A process specifically needs outside customers to be viable, right? This just feels like such a huge, risky undertaking.
It truly is. I mean, this is a monumental pivot. Intel's history is designing and making their own chips. Becoming a foundry means competing head-on with giants like TSMC and Samsung, who've been doing this for decades.
And it's expensive.
Unbelievably expensive. Building these state-of-the-art fabs costs billions upon billions. So here's the crux. Without major external clients signing up, booking capacity for processes like 14A, those multi-billion-dollar factories, they just become a massive financial drain.
So analysts are skeptical.
Very. They're definitely questioning the feasibility. You hear speculation about Intel maybe having to go fabless, eventually just design outsourced manufacturing, or even selling off these foundry assets if they can't land the big customers. It's a really high-stakes gamble.
Okay, so if the bad shows the financial struggles, the ugly really highlights the market's reaction to maybe deeper structural problems.
Yeah.
Despite that slight revenue beat we started with, Intel's stock dropped about 9% right after earnings.
Yeah.
That sends pretty clear message about investor confidence, doesn't it?
It absolutely does. A drop like that, even with a revenue beat, tells you the market is looking past the headline number. They're focused on the underlying financial health, the future uncertainties.
They're looking at the losses.
Exactly. They're looking at what you lost, not just what you earned, and what that implies. That ongoing negative earnings trend, JAP net income down a whopping 81% year over year. It's a stark reminder of how far they still have to go. It signals a real lack of confidence in near-term profitability.
It may be the ugliest detail in all this. The performance of that chip-making segment itself, the Foundry arm we just discussed, sources say it lost roughly $3.2 billion. That sounds less like a strategic bet, more like a major strategic headache right now.
Indeed. I mean, losses of that size in a key strategic segment, that's a significant drag on the whole company. It's a critical concern for investors.
Connects back to the whole turnaround difficulty, right?
Absolutely. It just underscores how incredibly difficult this path is. Future success really hinges on them delivering those 18A and 14A nodes and getting those CapEx cuts implemented and, crucially, finding those external customers. Without them, these losses just keep piling up. It feels more like an anchor than a pillar right now.
Okay, so we've hit the earnings of the P&L. But to really get the full picture of Intel's health, especially during this massive transformation, we need to look at cash flow, the lifeblood, right?
Crucial. Absolutely crucial.
You, our listener, were asking about their cash position, how they're funding this huge pivot. And the sources show a complex picture. Operating cash flow for the TTM, the trailing 12 months, was actually positive.
Yeah.
$10.32 billion. That sounds pretty good on the surface, doesn't it?
Yeah.
Generating cash from operations.
It is a good sign, yes. Their day-to-day business is bringing cash in the door. However, and this is where it gets really interesting, maybe a bit counterintuitive.
Okay.
Their levered free cash flow, also TTM, is negative. Negative $7.0 billion.
Right. So this is the big question then. How can operating cash flow be positive, but free cash flow be negative? What's going on there for Intel?
That's the key point to unpack. Think of it like this. Operating cash flow is like your paycheck, money coming in from the job.
Good.
Free cash flow, especially levered free cash flow, is what's left after you pay all the bills, including your really big investments. And for Intel, those big investments, that's their massive capital expenditures, CapEx.
Building the factories, developing the tech.
Exactly. Billions spent on building new, cutting-edge fabs, developing advanced tech. Sources put their CapEx around $21 billion. That's way, way higher than the cash their operations are bringing in.
So it's like earning a good salary, but spending way more renovating the house.
Precisely. Spending vastly more on the house renovation, the new tools, upgrading everything, draining savings in the process. For Intel, the renovations are these multi-billion-dollar fabs and R&D efforts.
And that drives the negative free cash flow.
That's what's driving it. Those huge investments in new foundries, developing 18A, it leads to negative free cash flow. And their overall net cash flow for the last 12 months was also negative, about $1.59 billion.
Okay, let's unpack that a bit more. Intel is clearly deeply in this capital-intensive turnaround mode, spending huge amounts now for future leadership. So what's the specific growth strategy moving forward? And maybe more importantly, how are analysts actually viewing their chances?
Well, the core strategy is this massive realignment. It's all about pushing towards their faster, more advanced 18A node technology and really sharpening the focus on AI chips, trying to skate where the puck is going, so to speak.
Under the current CEO, Pat Gelsinger.
Right. He's leading this huge restructuring, sharper focus on profitability, on core products. We talked about the layoffs, the canceled megafabs. That's all part of trimming costs and directing money more effectively.
And how's the street seeing it? What are the predictions?
Analysts, if you look at Yahoo Finance estimates, they're expecting 2025 revenues somewhere around, say, $47–48 billion. Critically, though, the estimated earnings per share, EPS, is hovering near break-in or maybe a slight loss, around $0 to maybe negative $1.10 per share.
So not expecting profits yet?
Not really, no. And the average analyst rating, it's basically a hold. Price targets are around $22, $25, which, notably, is pretty close to where the stock is trading now.
So a very cautious, neutral view, like, we see the plan,
But show us the results.
Exactly. There's cautious optimism about the turnaround plan. The cost discipline gets them some credibility. Market Beat notes that. But outlets like Business Insider, The Verge, they really stress this pivot away from just aggressive expansion towards a much more focused, economically driven strategy.
Prioritizing getting back in the black.
Precisely. Prioritizing short-term viability, getting back to profitability over just maybe speculative long-term land grabs. The huge risks remain. That negative free cash flow can't last forever. And crucially, can they execute on these incredibly complex new process nodes like 18A? It's a massive execution challenge.
Okay, so pulling all this together, what should you, the listener, really be watching for in the coming quarters, the next couple of years? What are the real signs this turnaround is working or not? Yeah, key things to track. First, the actual execution on 18A and the Panther Lake CPU ramps. Are they delivering on time, with performance? That's huge.
Technology delivery.
Second, can they actually attract those external clients to the Foundry business? We need to see names, commitments. Are they filling those expensive fabs?
Foundry success.
And third, just clear, undeniable improvements in margins as we head into 2026. Those profit numbers need to start turning around. That will tell the real story.
Okay, so let's try to sum it all up simply. Paint the whole picture. The good. You've got that slight revenue beat, some promising growth in AI and data center, really aggressive cost discipline, and the product roadmap seems solid for now.
Right.
The bad. Those ongoing quarterly losses, 6 in a row now, the significant margin pressure, and just huge uncertainties around that big Foundry bet. And the ugly. That sharp stock drop signaling investor skepticism, the deep structural losses, particularly in the Foundry segment, and what still feels like, for many, a really unclear and incredibly challenging turnaround path ahead.
That's a really good summary. Intel's Q2 paints this deeply complex picture. You've got positives like top-line growth, roadmap progress, but the steep losses, the margin weakness, that whole Foundry strategy, they raise really serious execution questions you just can't ignore.
So investors are watching execution.
Intensely. They're focused on Intel's ability to deliver on nodes like 18A and fundamentally rebuild consistent profitability, probably looking out towards 2026, maybe 2027. It's a real high-wire act with billions, literally billions at stake.
Wow. What a deep dive into Intel's journey. It really is this fascinating balance, isn't it, between this ambitious vision reclaiming tech leadership and the just tough, brutal reality of the financial numbers.
It is.
It just shows how absolutely critical execution is, especially in semiconductors, such a fiercely competitive, capital-hungry industry.
It really does. And maybe this raises an important question for you, the listener, to think about. How do huge companies like this balance these massive, multi-billion-dollar long-term investments against the immediate, often really painful demands of short-term financial performance? Especially when you're trying to turn a super tanker like Intel around.
Yeah.
It's an incredibly tough tightrope walk. A lot of big tech companies are facing versions of this, and Intel's story right now is just a really compelling, high-stakes case study.
Absolutely. A lot to think about there, and definitely a company we'll keep watching closely. Thank you for joining us for this deep dive into the chart ledger.
My pleasure.
We hope you feel a little more well-informed, maybe a bit more curious about this whole intricate world of tech finance. Until next time.